Welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at Market Site in Times Square, we have Sean Cruz. He is the manager of trader strategy over at TD Ameritrade. We're going to take a look at earnings season now that we finally have a catalyst back in the market. Sean, it's great to have you, as always, on Trade Talks. And let's run through earnings season progress right now.
So far, we've actually gotten a little bit of, I think, a more positive earnings season than what we were hearing. If we look up here and notice all securities on the far right, earnings growth coming in a little over 3%. I think that's pretty positive considering there was a lot of talk about an earnings recession. I would point out we've only heard from 190 of the 500 S&P 500 components, so there's still plenty out there, but definitely not getting much help from energy. If you look over, earnings growth in the energy front, down 26.5%. Materials also down 12%, but seeing some pretty strong leadership out of communication services. And we've also had a lot of surprises on the upside from industrials, IT, and communication services as well. I think that's helping keep us in positive territory for earnings growth. And I think that's why you're not really seeing earnings growth coming in as low as some analysts were expecting, because we are just seeing some pretty good surprises across the board. And that's helping keep growth high. If you look at most of these sectors, all in positive growth territory.
I mean, look at communication services over here, 13.22% on earnings growth. No wonder the NDX, the Nasdaq comp, hit another intraday high today. I mean, you're really seeing that significant leadership in the tech space.
And you're really going to see, especially in communication services and information technology, you see some very high price names that can really push that around. And not only are they high price, but they're also very high market cap, which is going to give them a little bit more of a weighting in their ability to move around a lot of these indices.
Yep, just had another $1 trillion market cap out of Nasdaq today. But let's go and let's talk about the content wars just continue to heat up. It feels like what happened with the cable companies years ago when it was pretty daunting for all the a la carte services out there.
I think so. And what's interesting about the content wars and how they're shaping up right now is you're starting to see a lot of activity in the streaming space. And so it's funny, you mentioned a lot of the telecom companies, some of the studios. A lot of those companies started their own little foray into getting some streaming services out there. Didn't really play out the way they had expected it to. And so if you look at something like Hulu is something that used to have pretty split ownership, but now you're starting to see that ownership get consolidated. And I think that's an interesting trend to watch, is how a lot of these companies are going to go out there. Are they going to try and build out their own, or are they going to go out there and maybe try and consolidate some streaming service that is currently held across a few different companies?
Yeah, I mean, it might be challenging for consumers as it's going to be so fragmented, and that can eventually get very expensive. But
yes.
Purely from a market perspective, there is going to be a lot of consolidation in M&A. As you had suggested, it's just going to become unfeasible when you have 30, 40, 50 different content providers. We probably even surpass that at this point. It's just too expensive.
It does, and I think that was the big thing initially was, look, 3 content providers, 4 content providers, it's still cheaper than your $180 cable bill. But now when you start getting into 4, 5, 6, maybe we get up towards 8, 9, or 10, and you start adding on services. So now there's some companies out there where you can start tacking on other services through there, other streaming subscriptions like an HBO or Showtime, that starts piling up on those subscription services. And so that can make it start to get a little bit more pricey, whereas previously you could pretty much get 2 or 3 streaming services for under $40.
Right.
I think as you start getting more and more in there, that's going to start to move closer to 100.
Even within some of these content providers, particularly with premium sports packages, you can't just get it on, let's say, the ESPN app. Now they have ESPN Premium for certain fights or whatever it is. So it's like it's even fragmented within the content providers.
It is, and that's what I mean by the content providers going out there and finding different ways to get into different services. Amazon Prime, you can get HBO and Amazon Prime. You get some of the premium movie channels out there. You can also get them in Hulu. Can't do that in Netflix. Then you have YouTube TV. You can add services onto there that maybe you can't get in Hulu or elsewhere. So it's still a very fragmented space where there's not necessarily one player you can go to get all the services you want.
Just can't keep up.
Yep.
All right, Sean, thank you so much as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.